While entering into straddles feels like standing in the exact spot of the action, strangles are like standing on the opposite sides of action. Here is a quick example. This is how the payoff diagrams of straddles looks like, whereas for strangles, you have flat lines on both the top as well as at the bottom. So let's explore how strangles gives you more options as well as more room for error. I am Pranav VK, your strategy guide here at Stockshaala by Kotak Securities. In this video, we are going to understand everything about strangles and the various options that we can go ahead and use them for. So let's understand what is a strangle in the first place. A strangle is created by using a call and put option of the same expiry but using different strikes. It often gives us a wider range and most importantly, it is cheaper to enter. There are two types. The first one is a long strangle, whereas the second one is a short strangle. A combination of buying an out-of-the-money call as well as an out-of-the-money put creates a long strangle, whereas selling an out-of-the-money call and selling an out-of-the-money put creates a short strangle. Let's understand each of them in deeper detail, starting with the long strangle, where we are betting on big moves on either side. A long straddle is created by buying an out-of-the-money put as well as an out-of-the-money call of the same expiry. Let's take an example to understand this better. So for this example, I'm considering Nifty to be at 20,000 and we are trying to go for a long strangle in this case. So we're buying 19,600 put option which is out of the money at rupees 50, and we are also buying a 20,400 call option which is again out of the money at rupees 60. So the total cost to enter into the strategy is rupees 110. So the break-even points are calculated by the higher strike plus the total cost, whereas on the lower side it is the lower strike minus the total cost. So now we'll also look at the payoff diagram for much more visual clarity. So here we have the payoff diagram for the long strangle. So on the y-axis we have the profit as well as the losses, and on the x-axis we have the possible strikes at the end of expiry. So to start with, let's look at the maximum losses. So this strategy is going to have a maximum loss if the market stays between 19,600 as well as the 20,400, which is the strikes that we have purchased in the beginning, both the put option as well as the call option. As and when the market approaches near the break-even point, the losses keep reducing and the break-even points are calculated given by the formula as mentioned earlier. Beyond both these break-even points, the profit is unlimited for this specific strategy. Here are three things that you have to remember regarding a long straddle. It is cheaper to execute than a straddle. The second thing is that it requires a bigger move for you to start making a profit. And the third thing is that it has unlimited upside. Now let's explore short strangle, which is the exact opposite of a long strangle. So in this example, Nifty is again at 20,000 for ease of understanding, and we have sold a 19,500 put option by receiving a premium of rupees 100, and we are selling a 20,500 call option at rupees 50. So since we are selling both of them, we have totally received a credit of rupees 150, which means that also becomes our maximum profit. For break-even points, it is the higher strike plus 150 and the lower strike minus 150. So here we have the payoff diagram of a short strangle. So we have the profit and loss on the y-axis, and on the x-axis we have the possible strikes. So you can have a look at the break-even points. So as and when the price approaches near the break-even points, the profits are reducing and goes towards unlimited losses on either side. But whereas if the market stays in between 19,500 and 20,500, then this strategy is going to give you maximum profit. Here are three things you have to remember regarding a short strangle. So a short strangle is going to be less riskier than a short straddle because here it gives you a higher range, whereas in a short straddle it is like a triangle and it doesn't give you much range. The second point to remember is that it requires a range-bound view of the market to enter into this strategy and actually make a profit. The third one is my favorite. You benefit from Theta Decay as well as the falling IV. So far, in the previous video as well as this video, we learnt about the different types of straddles as well as strangles. Now we will compare a straddle with a strangle. To start with, for a straddle, you're going to have the same strike prices, whereas for a strangle, you're going to have different out of the money strike prices. The second one is that cost. Straddle has a higher cost, whereas strangles have comparatively lower costs. The break-even points in a straddle are much closer, whereas in a strangle, they are much wider, giving us more room and bandwidth. And finally, when it comes to probability, the probability of making profit in a straddle is much lower, whereas for a strangle, it is much higher. Now, don't get confused between probability of selling versus probability of buying and the probability we are talking here. Here, in this case, we are talking about probability for the specific strategy and not for buying or selling. And finally, we have the miniature payoff diagrams of both of them. Here for a straddle, you can see that it is clearly triangular in shape. So this is for a short straddle and this is for a long straddle, whereas this is for a short strangle and this is for a long strangle. Here, for us to make a profit in a short straddle, we want the market to be range bound. Whereas in a long straddle, we want the market to be moving on either sides, either on the upside or on the downside. But when it comes to a short strangle, we will be profitable in a specific range, so we have a wider bandwidth compared to a short straddle. And in a long strangle, you need a very comparatively big move when compared to a long straddle. So here in this case, you must be absolutely sure that there is too much movement that is expected on either the upside or on the downside. Here is a pro tip. When you go for a short straddle or a short strangle, it is equivalent to a net credit spread, which means it is equivalent to option selling and your probability of profit is going to be more than 66%. But when you go for a long straddle or a long strangle, in this case, it is equivalent to option buying and your probability of profit is less than 33%. So don't look for what is cheaper, but look for where the probability of profit is higher. Now let's discuss when to use a long strangle versus when to use a short strangle. You can go for a long strangle when the IV is low, a big event is upcoming, and finally you want a cheaper exposure than a straddle. And you can use a short strangle when the IV is high and you expect the market to be range bound, and finally you want to earn from time decay. But always remember that a short strangle has unlimited loss potential, so risk management as well as stop losses is of utmost importance. Let's summarize what we have learned so far. We understood that a strangle is nothing but a call as well as a put option with different strike prices and the same expiry. There are two types of strangles. One is a long strangle and the other one is a short strangle. By buying an out-of-the-money call option as well as out-of-the-money put option, you are entering into a long strangle. Whereas, if you are selling an out-of-the-money call option and out-of-the-money put option, then you're getting into a short strangle. You can go for a long strangle when you expect a really big move in the market, but you go for a short strangle when you expect the market to be range-bound. And finally, we also looked at when you can go for a long strangle versus a short strangle. And not just that, we also looked at the differences between a straddle as well as a strangle. In the upcoming video, we are going to go one level higher and we're going to explore strategies like Iron Condor as well as Iron Butterfly. So stick around because this is going to be a masterclass in range trading. You're watching Stockshaala by Kotak Securities. Like, share and subscribe. I am Pranav VK and I'm going to see you in the next video.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.